Welcome back to Business Tonight. According to the World Bank, South Africa's Gini coefficient is deemed among the highest in the world. It's therefore not surprising that salaries and salary increases have become much more than a pure business concern in recent years, especially in the mining sector. Martin Westcott from PE Corporate Service and Gavin Hartford from the ESOP Shop join us in studio. Gentlemen, thanks very much. We've just spoken to Stephen Koster, CEO of Investec, and he was saying that South Africa Incorporated needs to put together a much better story to start, one, the rand falling out of bed, and secondly, to get that confidence back in our economy. With the current strike environment, let's get an update, Martin, from your side as to whether that is possible, or are we just headed down a very, very rocky road?
I think if we contemplate meeting the paid amount of 12,500 a month, we will risk falling out of bed. Our salaries are not bad in this country. It's very, very difficult to draw international comparisons. If you start comparing people with that skill level in South Africa and compare them to what people earn in Europe, in the UK, in the US, even in Australia, for example, which is a mining economy, they're not directly comparable, because you've got massive differences. You've got cost of living differences, you've got different social policies in the countries concerned, and so on and so on. But look at somebody at that skill level in Europe, for example. They'd be earning the equivalent of 25 to 30,000 a month approximately. Same in the States, roughly the same in Australia. But then you've got to factor in the fact that if you go into Sydney, for example, and want to go to a movie or go to dinner, you're going to pay 201 over 100 times what it costs you in Johannesburg, if I take the current cost of living indices. So it's quite a complex issue.
It's a very complex issue. In fact, I was in Melbourne recently watching my disastrous English cricket team lose to Australia, and I went for a beer, which I sometimes do, and it was 72 rand for a small pint, which they call a pot, a small half a pint, rather, which they call a pot in Melbourne. And I thought to myself, 72 rand, how do these people live? And then I spoke to a Nepalese taxi driver who earns 42,000 rand per month equivalent. What I'm saying here is that, do you think that South Africa is not falling behind when it comes to wages, but falling behind when it comes to the attracting of skills? Because according to people like AdCorp, we have 700,000 unfilled skilled vacancies in this country, but people won't come here because we don't pay them enough.
Gavin, this is to you.
Well, I would imagine that we have been trying for nearly 20 years to invest in the growth of the skills market, probably quite unsuccessfully. And I think the biggest skills gaps that we face in the manufacturing and mining side of the economy is in the artisanal and technical skills area. I think that's where the country is focusing all of their skills effort, and indeed I think that's where we need to focus all of our skills efforts. That's what I've got to say on skills right now.
David?
Just Martin or Gavin, with the rand at 11.20, I don't think we're fully discounting what this is going to mean for inflation down the line. How do you think this will translate into further unrest or action in the labour market?
I think the potential for unrest is there all the time, David. It's a serious risk. If you look at what's happening in salary increases, for example, we're running within the major corporations with predicted increases of around about 6 to 7%. Give or take, a third of companies, as we sit here right now, according to our stats, are going to award less than 6% in the coming year. But if you look at the bargaining unit, the lower level in the organisation, they're talking of 8 to 10%, because that's where the wage settlements come to, if you're lucky. So,
I say this against
the inflation impact
prices,
is quite real.
Yeah, I say this against petrol prices, where in our basket maybe a taxi fare is not a big deal, but for a lot of workers going to and from work or to their firm employment are going to find that whatever they have left is being taken away. There's got to.
I think that the major problem that you're facing in industrial relations is the kind of last decade problem, is that whereas previously union negotiations used to be based on CPI adjustments, and that was the measure, plus 1%, plus 2%, but now it's not part of the conversation at all. And in fact, it's a contested terrain in respect of labour and business as to what is the actual basket of goods to measure a CPI increase in relation to blue-collar employees. There's no consensus, in my view, from engaging with both labour and business on this, that the two parties even agree how to measure CPI. We've seen consistently well above CPI increases for the last 5 or 6 years. So to have a conversation as South Africans as to what is the impact of CPI increases on wage negotiations are kind of a bit of a misnomer. I think the bigger issue is how do we get a consensus, a national consensus around minimum rates and productivity increases so that we grow the economy.
We mentioned the fact that we're looking at cost of living allowances, etc. But the fact of the matter is business is not a charity. You're not concerned so much about how much your workers are making, it's how much they're making relative to how much profits you're making. And we have, as you mentioned, productivity problems. You know, they haven't had the increase in productivity that matches the increases in wages. So at what point in time are we going to start seeing labour being cut out of the equation? You know, reductions coming through, mechanization coming through, or is that a danger that we can avoid in this country?
I think that's happening already. I think that there's increasing investment in capital as opposed to labour. I think that business is taking business decisions. And I think it's a great pity, frankly, because like what Stephen was saying earlier about the, you know, the virtuous circle between labour, business and government is we have to get together and we have to say that this ad hoc process of self-destruction of value needs to come to an end for all of us, for government, for business and for labour. We have to turn us from a doom and gloom economy into a growth economy. And that means, fundamentally, that it's not a conversation just about what we can get from each other. It's a conversation about what we're going to put into the pot that we currently have, that we're going to put into the pot to make the pot grow more.
What do you reckon will trigger that?
Well, I think
what's going to trigger
there's not a single event, because the NEDLAC Act was the first act of the Democratic Parliament in 1994, and NEDLAC today is pretty well hamstrung. So I don't think it's a single event. I think that what is going to happen is that as each party realize we're on a lose-lose scenario, eventually people will come together, and it's fantastic to hear Steve and others talking about it at a senior level of how we can start a real conversation around a social contract for this country, which is not a contract just about who's going to give to the other. It's about what we can all put in the pot to make the pot grow for all of us.
Gentlemen, I think we're missing the point here completely. I mean, this piece that you sent us earlier on says salaries and increases are now more than just a business issue. I think that if we had the lovely problem where there was only 3.5% or 4% unemployment in South Africa, then we wouldn't worry about increases and the link between increases and inflation, and whether the person at the top, like David Shapiro, is earning 2 million a month, or the person at the bottom is earning 2,000 a month. It wouldn't matter. We've got to fix it. Never mind who earns what. It should be all to do with productivity and to do with gross domestic product and the performance of the South African economy, surely.
Martin, if you want to take this as a final word.
We've had very little progress in creating a social compact between labour and business, and labour and top management, if you like, and I think that's one of the sad things. You know, the whole 12,500 rand per month negotiation scenario is driven by the fact that people at that level don't have money to live on. You know, nobody sits down and says, well, in fact, we've been a little irresponsible in educating people about saving, for example. Their garnish orders, which go off my salary, this gets deducted, housing gets deducted. All of a sudden, I've got nothing to live on, and the 12,500 not the issue. I want some net money to live on during the course of the month. So we need to educate. We need to get union acceptance that the notion of productivity is critical in increasing earnings. You know, the basic contemporary thinking in remuneration today is that if you increase pay, you need to share the risk to some extent. So there's an incentive component that goes into the package. And you can take that right down to the very bottom level in the organisation. But there's very little acceptance within the unions, within COSATU, that should be contemplated. It's all about, we want as much money as possible. We're not very concerned about what happens in the organisation. You're driving big Mercedes, you've got lots of money, we want some of it.
Gentlemen,
and I think the education is critical in that regard.
Sorry, we're out of time. Thank you to Martin Westcott from PE Corporate Service and Gavin Hartford from the ESOP Shop. But let's recap news making headlines now with Tamishu.
Thanks, Bronwyn. PPC expects normalized earnings for the first half of 2014 to reflect a year-on-year improvement. The cement maker notes that volume